Hi everyone, welcome to TYG Trading. This will be the final episode to talk about. Hopefully, many will know better about how CFD works and how our profit and loss will go. From here, we also understand who our counterparts are. It's not the broker, but the liquidity provider. Again, the condition is valid under regulated brokers. Any regulator will be the same. Of course, different regulators have different way to supervise or rules to follow. If there are many questions about this, I will create a separate content to discuss the topic. In short, when there is an order, the broker will send it immediately to liquidity provider. That's all. So, the broker won't disturb our orders. When there are two traders open positions, one buys, another sells. Both orders won't be done in the broker. They will be sent to liquidity provider and they will be executed under a matchmaking process. How about the prices that are provided by the broker? The price comes from the liquidity provider. The problem is how the liquidity provider gets the price. Liquidity provider is a system that combines several market makers. Liquidity provider can also be an infrastructure company that provides service to access market maker. When a liquidity provider is a big broker, the big broker is actually acting as a relay to liquidity provider. There is no liquidity provider that only connects to a single entity of market maker. Since an LP is usually connected to many market makers, that means an LP will be connected to many banks and other financial institutions. Every bank has different prices to buy and sell. The next question is, with many connections to market makers, how can a broker get the price for us? Many assume broker is our counterpart. When we win, the broker is losing money. When we lose, the broker is gaining money. When we win, it is someone else's money. When we lose, our money will be taken by someone. Is trading a zero-sum game? This is not how a broker works, at least not for the regulated one. When there is a regulator, there will be rules on how to operate a broker. Liquidity provider is also be under regulation. So let me share about how a broker got the price under regulation. My explanations won't be 100% accurate. It is more and less. Again, when a broker has connection to an LP is actually connected to several market makers. Let's say there are Bank A, Bank B, and Bank C. Probably there are also big investment firms with the need to have currency exchanges. We call them market makers. Every market maker will have two prices, bid and ask price. Bid is the price they are willing to buy. Ask is the price they are willing to sell. Bid's price is always lower compared to ask price. Look at the table. We have 3 banks and 1 institution as our liquidity provider. A system will look for the highest bid price and the lowest ask price. This will be the broker's price. So the broker will have bid price 1.3 and ask price 1.34. When the broker is earning from the spread, they will add or mark up the price to us. If they want profit 0.05 for each positions, they will give us bid price 1.35 and ask price will be 1.39. So every time we open and close a position, the broker will have a profit of 0.05 immediately. Now, does it clear how broker makes money? Next, answering if CFD is really a zero-sum game. By looking at the table, we know who will be our counterpart. As for now, when we buy, our counterpart will be Bank A. At the same time, when we sell, it will be done by Bank C. The system will always find the best price for us, so we can't really know who our counterpart is. Our transaction in CFD is just a small part of the transaction in the market maker. They buy and sell currency to everyone who needs it. We buy Euro USD, it is actually an activity to buy Euro from a USD account owned by a broker. It is then happen in a bank as probably a part of a big transaction belonging to a multinational company that is buying currency to pay their debt to their overseas business partner. So, the CFD transaction is done randomly, based on supply and demand. The best price can be from different banks. Considering market volatility, our order will be executed mostly by different banks. So when we open a contract, it is done by Bank A. Next time we close the contract, it will be on a different bank. All are done randomly based on the best price. Since the currency transaction in banks are done very fast, based on economic activities such as export, import, interbank exchange, and many others, all transactions are done according to real business activity, based on requirement and rates. There is no principle of winning and losing here. Our profit comes from the volatility of the exchange rate. The same to our losses. All of them are about currency supply and demand. So can we see here why is trading CFD is not categorized as a zero-sum game? When we use a regulated broker, our transaction is actually done through the banks. This type of broker is called HTP. How about market maker? How do they execute our orders? Will they become our counterparty? Definitely not, as long as they are regulated. Market makers means they have enough liquidity to provide services for our orders. Most of them operate like a bank, such a big money changer on a national scale. Having this kind of market, they can manage their own liquidity. The secret for a market maker to stay profitable is their skill to hedge and arbitrage. For those who don't know what they are, will never know how market maker makes money. Alright, now I have explained how liquidity provider provides a service to process our transaction. Hopefully it will be helpful for us traders to know deeper about brokers. See you next time. TYG out. If you enjoy my contents, feel free to subscribe and a like will be very much appreciated as well. You may also leave questions in the comment section. I will try my best to answer honestly.